So now in that same stream of long-term financial planning, we're using Ross Westerfield Jordan's Fundamentals of Corporate Finance to understand how to calculate sustainable growth rate. Assuming the following ratios are constant, what is the sustainable growth rate? In this case, you've been given total asset turnover, profit margin, equity multiplier, and payout ratio. Most immediately, you'll recognize that these first three are associated with the DuPont analysis. And so we start off with that. According to the DuPont analysis, ROE equals to our profit margin multiplied by our total asset turnover multiplied by our equity multiplier. And so all three elements are present right in front of us. We're just going to go ahead and plug them in. Profit margin is 7.5%, so that's 0.075. Our total asset turnover is 1.6 times. We're going to go ahead and put that in there. And our equity multiplier is 1.95. And so putting that into our calculator, we get 0.075 multiplied by 1.6 multiplied by 1.95. And we get a return on equity of 0.234 or 23.40%. Now, going one step further to calculate the sustainable growth rate, we're going to need two elements within our formula. So sustainable growth rate is equal to our ROE multiplied by our retention ratio divided by 1 minus ROE multiplied by our retention ratio. In this case, we now have ROE, but we need our retention ratio. Our retention ratio is equal to 1 minus our dividend payout ratio. And so that means that we're going to do 1 minus 0.40, which is equal to 0.60. So we've got a 60% retention ratio. Plugging in the two numbers required, we've got 0.234 as our ROE and 0.60 as our retention ratio. So 1 minus 0.234 multiplied by 0.60. Putting that into our calculator, we get 0.1404 as our numerator, and we get 0.8596 as our denominator. And that gives us a sustainable growth rate of 0.1633 or 16.33%. Don't forget to like and subscribe. And if you have any questions, please comment below. Thank you.